Annuitant and Beneficiary. An annuitant is the person who receives benefits from the annuity, with their life expectancy considered in the annuity calculation. The beneficiary is the person who receives annuity assets if the annuitant dies during the accumulation period. Accumulation versus annuity period. The accumulation period is when payments are made into the annuity, and interest is earned on a tax-deferred basis. The annuity period is when accumulated funds are converted into income payments for the annuitant. Premium payment options. Annuities can have different premium payment methods, single premium or periodic, and income payments can start immediately or be deferred. They can also be fixed or variable. Non-forfeiture and surrender charges. Non-forfeiture laws ensure a guaranteed surrender value for deferred annuities, with a penalty for early withdrawals. Surrender charges compensate for early surrender of a deferred annuity. Fixed annuities. These offer guaranteed interest rates and fixed income payments. They are invested in the insurer's general account. Variable annuities. Variable annuities offer variable returns and are regulated by the SEC. They are invested in a separate account and do not guarantee minimum interest rates. Annuity benefit payment options. Payment options include pure life, payments cease at death, life with guaranteed minimum, remainder paid to beneficiary, and annuities certain, payments for a fixed period or amount. Uses of annuities. Annuities are commonly used for retirement income, but they can also serve as lump sum settlements, fund long-term care, or provide guaranteed minimum withdrawal benefits. This information provides a comprehensive overview of annuities, their types, and how they can be used to meet various financial objectives. Annuitant. The person who receives benefits or payments from the annuity, whose life expectancy is taken into consideration, and for whom the annuity is written. The annuitant and the contract owner do not need to be the same person, but most often are. A corporation, trust or other legal entity may own an annuity, but the annuitant must be a natural person. Know this. Because annuities are based on the life expectancy of an annuitant, the annuitant must be a natural person, regardless of who owns the policy. Beneficiary. The person who receives annuity assets, either the amount paid into the annuity or the cash value, whichever is greater, if the annuitant dies during the accumulation period, or to whom the balance of annuity benefits is paid out. 2. Accumulation versus annuity period. The accumulation period, also known as the pay-in period, is the period of time over which the owner makes payments, premiums, into an annuity. Furthermore, it is the period of time during which the payments earn interest on a tax-deferred basis. The annuity period, also known as the annuitization period, liquidation period, or payout period, is the time during which the sum that has been accumulated during the accumulation period is converted into a stream of income payments to the annuitant. The annuity period may last for the lifetime of the annuitant or for a specified period, which could be longer or shorter. The annuitization date is the time when the annuity benefit payouts begin, trigger for benefits. Know this. During the accumulation period, funds are paid into the annuity. During the annuity period, funds are paid out to the annuitant. The annuity income amount is based upon the following: the amount of premium paid or cash value accumulated, the frequency of the payment, the interest rate, and the annuitant's age and gender. An annuitant whose life expectancy is longer will have smaller income installments. For example, all other factors being equal, a 65-year-old male will have higher annuity income payments than a 45-year-old male, because he is younger, or than a 65-year-old female, because women statistically have a longer life expectancy. Know this. Shorter life expectancy equals higher benefit. Longer life expectancy equals lower benefit. If an annuitant dies during the accumulation period, the insurer is obligated to return to the beneficiary either the cash value or the total premiums paid, whichever is greater. If a beneficiary is not named, the death benefit will be paid to the annuitant's estate. 3. Premium payment options. Annuities can be classified according to how premiums are paid into the annuity, how premiums are invested, and when and how benefits are paid out. Know this. Classification of annuities. Premium payment method. Single premium versus periodic. When income payments begin. Immediate versus deferred. How premiums are invested. Fixed versus variable. Disposing of proceeds. Pure life, annuity certain, or life refund annuity. The first way to classify annuities can be based on how they can be funded, paid for. There are two options: A. Single premium. One-time lump sum payment, or through periodic payments, in which the premiums are paid in installments over a period of time. Periodic payment annuities can be either level premium, in which the annuitant owner pays a fixed installment, or flexible premium, in which the amount and frequency of each installment varies. B. Immediate versus deferred annuities. Annuities can also be classified according to when the income payments from the annuity begin. An immediate annuity is one that is purchased with a single, lump sum payment and provides income payments that start within 1 year from the date of purchase. Typically, an immediate annuity will make the first payment as early as 1 month from the purchase date. Most commonly, this type of annuity is known as a single premium immediate annuity, SPIA. A. Deferred annuity is an annuity in which the income payments begin sometime after 1 year from the date of purchase. Deferred annuities can be funded with either a single lump sum, single premium deferred annuities, SPDAs, or through periodic payments, flexible premium deferred annuities, FPDAs. Periodic payments can vary from year to year. The longer the annuity is deferred, the more flexibility for payment of premiums it allows. Know this. An immediate annuity is purchased with a single premium. Know this. Income payments from a deferred annuity begin sometime after 1 year from the date of purchase. 1. Non-forfeiture. The non-forfeiture law stipulates that a deferred annuity must have a guaranteed surrender value that is available if the owner decides to surrender the annuity prior to annuitization, e.g., 100% of the premium paid, less any prior withdrawals and related surrender charges. However, a 10% penalty will be applied for early withdrawals prior to age 59.5. 2. Surrender charges. The purpose of the surrender charge is to help compensate the company for loss of the investment value due to an early surrender of a deferred annuity. A surrender charge is levied against the cash value, and is generally a percentage that reduces over time. A common surrender charge might be 7% the first year, 6% the second year, and 5%, 4%, 3%, 2%, 1%, and 0% respectively thereafter. Therefore, if the annuity is surrendered in the 8th year or after, there would be no further surrender charge. At surrender, the owner gets the premium, plus interest. The value of the annuity, minus the surrender charge. Example. Assume that the annuity owner paid $700 in premium, which accumulated a total of $35 of interest, and a surrender charge is $70. If the annuity is surrendered prematurely, what will the annuity value be at surrender? The answer is $665. $700 premium plus $35 interest. $70 surrender charge equals $665 value of the annuity. See Annuity Products Investment Options. Annuities may be classified as fixed or variable based on how the premium payments are invested. 1. Fixed annuities. A. Fixed annuity provides the following features: guaranteed minimum rate of interest to be credited to the purchase payments. Income, annuity, payments that do not vary from one payment to the next, and the insurance company guarantees the specified dollar amount for each payment and the length of the period of payments as determined by the settlement option chosen by the annuitant. With fixed annuities, the annuitant knows the exact amount of each payment. received from the annuity during the annuity period. This is called level benefit payment amount. A disadvantage to fixed annuities is that the purchasing power that they afford may be eroded over time due to inflation. General account assets. Fixed annuity premiums are deposited into the life insurance companies. General account. The general account is comprised mostly of conservative investments, like bonds. These investments are secure enough to allow the insurance company to guarantee a specified rate of interest, as well as assure the future income payments that the annuity will provide. Know this. In fixed annuities, the premiums are deposited in the company's general account. Interest rate guarantees, minimum versus current. In fixed annuities, the insurer bears the investment risk. Future interest rates actually paid by an insurer are based upon the performance of the insurance company's general account. However, the rate may not drop below a policy's guaranteed minimum, typically 3%. Should interest rates drop below this guaranteed rate, the insurer is obligated to pay the guaranteed rate amount. During the accumulation phase, the insurer will invest the principal, or accumulation, and give the annuitant a guaranteed interest rate based on a minimum rate as specified in the annuity, or the current interest rate, whichever is higher. The minimum rate is the lowest rate that the principal can contractually earn. Equity indexed annuities. Indexed, or equity indexed, annuities are fixed annuities that invest on a relatively aggressive basis to aim for higher returns. Like a fixed annuity, the indexed annuity has a guaranteed minimum interest rate, typically 3 or 4%, which provides a guarantee for a certain rate of growth. At the end of the contract term, the annuity will be credited with the greater of the guaranteed minimum value or the current indexed value. The current interest rate that is actually credited is often tied to a familiar index like the Standard & Poor's 500. Generally, the insurance companies reserve the initial returns for themselves but pay the excess to the annuitant. For example, the company may keep the first 4% earned for itself, but any accumulation in excess of 4% is credited to the annuitant's account. So if the interest earned is 12%, the company keeps 4% and credits the client's account with 8%. Equity indexed annuities are less risky than a variable annuity or mutual fund but are expected to earn a higher interest rate than a fixed annuity. 2. Variable annuities. A variable annuity serves as a hedge against inflation, and is variable from the standpoint that the annuitant may receive different rates of return on the funds that are paid into the annuity. Listed below are the 3 main characteristics of variable annuities. Underlying investment. The payments that the annuitant makes into the variable annuity are invested in the insurer's separate account, not their general account. The separate account is not part of the insurance company's own investment portfolio, and is not subject to the restrictions that are applicable to the insurer's own general account. Interest rate. Issuing insurance company does not guarantee a minimum interest rate. License requirements. A variable annuity is considered a security and is regulated by the Securities Exchange Commission, SEC, in addition to state insurance regulations. An agent selling variable annuities must hold a securities license in addition to a life insurance license. Agents or companies that sell variable annuities must also be properly registered with FINRA. Variable premiums purchase. Accumulation units. In the fund, which is similar to buying shares in a mutual fund, accumulation units represent ownership interest in the separate account. Upon annuitization, the accumulation units are converted to annuity units. The income is then paid to the annuitant based on the value of the annuity units. The number of annuity units received remains level, but the unit values will fluctuate until actually paid out to the annuitant. Features. Fixed annuity. Variable annuity. Interest rate. Guaranteed by insurer. No guarantee. Underlying investment. General account. Safe, conservative. Separate account. Equities, no guarantee. License needed. Life insurance. Life insurance plus securities. Expenses. Guaranteed. Guaranteed. Income payment. Guaranteed. No guarantee. D. Annuity benefit payment options. Annuity payment options specify how annuity funds are to be paid out. They are very similar to the settlement options used in life insurance that determine how the policy proceeds are distributed to the beneficiaries. 1. Life contingency options. Pure life versus life with guaranteed minimum. The life annuity will pay a specific amount for the remainder of the annuitant's life. With pure life, also known as life only or straight life, this payment ceases at the annuitant's death, no matter how soon in the annuitization period that occurs. This option provides the highest monthly benefits for an individual annuitant. Under this option, while the annuity payments are guaranteed for the lifetime of the annuitant, there is no guarantee that all the proceeds will be fully paid out. Under the life with guaranteed minimum settlement option, if the annuitant dies before the principal amount has been paid out, the remainder of the principal amount will be refunded to the beneficiary. This option is also called refund life. It guarantees that the entire principal amount will be paid out. Know this. Pure life annuity provides the highest monthly benefit, but there is no guarantee that the entire principal will be paid out. There are two types of refund life annuities. Cash refund. When the annuitant dies, the beneficiary receives a lump sum refund of the principal minus benefit payments already made to the annuitant. Cash refund option does not guarantee to pay any interest. Installment refund. When the annuitant dies, the beneficiary will continue to receive guaranteed installments until the entire principal amount has been paid out. Note, however, that any unpaid annuity benefits following the death of an annuitant are taxable when paid to the beneficiary. Life with period, term, certain is another life contingency payout option. Under this option, the annuity payments are guaranteed for the lifetime of the annuitant and for a specified period of time for the beneficiary. For example, a life income. With a 20-year period, certain option would provide the annuitant with an income while the annuitant is living, for the entire life. If, however, the annuitant dies shortly after payments begin, the payments will be continued to a beneficiary for the remainder of the 20-year period. Single life versus multiple life. Single life annuities cover one life, and annuity payments are made with reference to one life only. Contributions can be made with a single premium or on a periodic premium basis with subsequent values accumulating until the contract is annuitized. Multiple life annuities cover two or more lives. The most common multiple life annuities are joint life, and joint and survivor. Joint life. Joint life is a payout arrangement where two or more annuitants receive payments until the first death among the annuitants, and then payments stop. Joint and survivor. The joint and survivor arrangement is a modification of the life income option in that it guarantees an income for two recipients that neither can outlive. Although it is possible for the surviving recipients to receive payments in the same amount as the first recipient to die, most contracts provide that the surviving recipients will receive a reduced payment after the first recipient dies. Most commonly, this option is written as joint and 1/2 survivor, or joint and 2/3 survivor, in which the surviving beneficiary receives 1/2 or 2/3 of what was received when both beneficiaries were alive. This option is commonly selected by a couple in retirement. As with the life income option, there is no guarantee that all the proceeds will be paid out if both beneficiaries die shortly after the installments begin. 2. Annuities certain types. In contrast with life contingency benefit payment options. Annuities certain are short-term annuities that limit the amounts paid to a certain fixed period or until a certain fixed amount is liquidated. Fixed period. With fixed period installments, the annuitant selects the time period for the benefits, and the insurer determines how much each payment will be, based on the value of the account and future earnings projections. This option pays for a specified amount of time only, whether or not the annuitant is living. Know this. The fixed period option pays for a specific time only, whether or not the annuitant is living. Fixed amount. With fixed amount installments, the annuitant selects how much each payment will be, and the insurer determines how long the benefits will be paid by analyzing the value of the account and future earnings. This option pays a specific amount until funds are exhausted, whether or not the annuitant is living. Uses of annuities. The principal use of an annuity is to provide income for retirement. However, an annuity may be used for any accumulation of cash or simply to liquidate an estate. Because of the various uses of annuities, agents should always assess how well a recommended product will meet the applicant's needs and resources. The suitability of a product. Know this. The main use of annuities is to provide retirement income. It is a producer's responsibility to make sure that annuity transactions address consumers' needs and financial objectives. To ensure suitability, producers must make a reasonable effort to obtain relevant information from the consumer and evaluate the following factors: age, annual income, tax status, financial needs and timeline, investment objectives, liquidity needs and liquid net worth, existing assets, intended use of annuity, financial experience, and risk tolerance. 1. Lump sum settlements. Annuities may serve as an ideal financial vehicle for someone who comes into a large lump sum of money, such as inheritance, lottery, award of damages from a lawsuit, proceeds from a sale of a business, or a lump sum distribution from a qualified pension plan. In this case, a person may purchase a single premium immediate annuity, which will convert the lump sum into a series of periodic payments, providing a stream of income for the annuitant. 2. Retirement income. Since annuities are a popular means to provide retirement income, they are often used to fund qualified retirement plans, which means they meet the IRS guidelines to receive favorable tax treatment. Qualified retirement annuities can be individual, such as individual retirement accounts, IRAs, and group, such as tax-sheltered annuity, TSA, or profit sharing pension plans. 3. Long-term care. Under the Pension Protection Act of 2006, annuitants are allowed to transfer money from an annuity to pay for long-term care insurance premiums, tax-free. In the past, distributions from non-qualified annuities were taxed. However, now, distributions can be used to pay for long-term care premiums and, in many cases, eliminate the taxes on the annuity gains. As a result, many insurers now offer a hybrid annuity with a long-term care feature. These policies provide for income, long-term care, or both. 4. Guaranteed minimum withdrawal benefit. Similar to the guaranteed minimum withdrawal benefit option, the guaranteed living benefit rider assures that the annuitant will receive at least the amount of money invested or a certain amount of income, usually up to the annuity purchase amount, regardless of market conditions. For that reason, this rider is generally offered to variable annuity investors where the value of the account depends solely upon the investment returns in the portfolio mutual funds. Often, this rider can be exercised only after a certain time period, e.g., after 10 years, and there is usually a fee for the rider that can range from 0.25% to 1% of the contract value annually. For example, If an annuitant invests $100,000 in an annuity and purchases the rider at a cost of 0.50%, $500 will be deducted from the account annually. If the account value declines to $75,000, the annuitant will still receive $100,000 as agreed. If, however, the account value increases, the annuitant has paid money out of the account, much like automobile insurance, and has lowered the value of his account by the amount of the fee. The rider is generally not applicable if the contract is surrendered and withdrawals are subtracted from the account value on a dollar-for-dollar basis. Each company's rider functions in a different manner, and it is important to understand the features of the product being offered. Chapter Recap. This chapter explained key concepts related to annuities, from the parties to the contract to different annuity classifications. Let's recap the main concepts you need to know. Annuities. Phases. Accumulation period. Payments in, to insurer. Annuitization period. Payments out, to insured. Parties. Annuitant. Insured. Policy issued on annuitant's life. Must be a person. Beneficiary. Will receive any amount contributed to annuity, plus any gain. If annuitant dies during accumulation period. Owner. Has all rights to policy, usually annuitant, can be corporation or trust. Types of annuities. Fixed annuities. Guaranteed. Fixed payment amount, premiums in. General account. Variable annuities, payment not guaranteed, premiums are in. Separate account, and invested in stocks and bonds. Indexed annuities. Interest rate tied to an index, earn higher rate than fixed annuities, not as risky as variable annuities or mutual funds. Premium. Payments. Single. One lump sum payment. The principal is created immediately, used for both immediate and deferred annuities. Periodic, level or flexible. Multiple payments. Annuity principal. Fund is created over time, used for deferred annuity only. Income payments. Immediate. Purchased with a single premium. Income payments. Start within 1 year of the date of purchase. Deferred. Purchased with either lump sum or periodic payments. Premium. Benefits start sometime after 1 year from the date of purchase, often used to accumulate funds for retirement. Settlement. Options. Lump sum. At annuitization, and all interest accumulated is taxable. Additional 10% penalty can be imposed prior to annuitants reaching 59.5. Life only. Insured cannot outlive income. Any monies not paid out are retained by company at insured's death. Pays highest monthly amount. Refund life annuity. Guaranteed lifetime income. If the annuitant dies, the balance is refunded to the beneficiary. The installment refund option pays the beneficiary until the purchase amount is paid out. The cash refund option refunds the balance of the original annuity purchase amount minus payments made to the annuitant. Joint life. 2 or more annuitants receive payments until first death. Then payments cease. Joint and survivor. Income for 2 or more that cannot be outlived. Often used with periods certain. When one annuitant dies, the other receives either 1/2 or 2/3 of the original payment amount. Life with periods certain. Specific monthly payment for life and a specific period of time. E.g., life plus 10-year certain. If the annuitant dies before the payment period is up, the payment goes to beneficiary. Annuities certain. Payments guaranteed for a fixed period or until a certain fixed amount is paid out. No life option. Any unpaid annuity benefits following the death of an annuitant are taxable when paid to the beneficiary. Interest rate guaranteed. Company must pay this minimum percentage, usually 3%. Current. Exceeds guaranteed rate. Paid to the annuitant when the company's own investment is better than expected. Thanks for watching.